Hi, welcome to watch the fifth video of corporate finance. Today's topic is the second part of capital structure. At the end of the last video, a question has been brought up. Why firms usually choose a leverage level that is much lower than the optimal level from a tax-saving perspective? The answer is provided in today's video. Today's video contains 5 parts. 1. Financial distress, default, and bankruptcy. 2. The costs of financial distress and bankruptcy. 3. The agency cost and benefit brought by leverage. 4. The implications of asymmetric information. 5. Capital structure, the bottom line. Let's get started. What could leverage bring to a firm? Financial distress. When a firm had trouble meeting its debt obligations, we say the firm is in financial distress. A firm that fails to make the required interest or principal payments on the debt is in default. Whether default occurs depends on the relative values of the firm's assets and liabilities, not on its cash flows. Many firms experience years of negative cash flows, yet remain solvent. When a firm is in default, debt holders can then take legal action against the firm to collect payments by seizing the firm's assets. To prevent such a seizure, the firm may attempt to renegotiate with the debt holders or file for bankruptcy protection in a federal court. Unlike financial distress and default, bankruptcy doesn't happen by itself. It is a choice the firm's investors and creditors make. Bankruptcy is a long, complicated, and costly process. This is because outside professionals, such as legal and accounting experts, consultants, appraisers, auctioneers, and others with experience selling distressed assets, are generally hired to handle the bankruptcy process. These outside experts are costly. Given the substantial legal and other direct costs of bankruptcy, firms in financial distress can avoid filing for bankruptcy by first negotiating directly with creditors. When a financially distressed firm is successful at reorganizing outside of bankruptcy, it is called a workout. Another approach is to make a prepackaged bankruptcy. That is, when a firm first develops a reorganization plan with the agreement of its main creditors and then file Chapter 11 to implement the plan. In this way, the firm can also pressure any creditors who attempt to hold out for better terms. We talked in the last slide that bankruptcy is a choice made by the firm's investors and creditors. Therefore, there is a limit to the costs on the investors and creditors that result from the decision of going through the bankruptcy process. On the other hand, there is no such limit on the indirect costs of financial distress, which we will see in the next slide. The indirect costs of financial distress that arise from the firm's customers, suppliers, or employees may be more substantial than other kinds of bankruptcy costs. These costs include 1. Loss of customers. Because bankruptcy may enable or encourage firms to walk away from commitments to their customers. Customers may be unwilling to purchase products whose value depends on future support or service from the firm. 2. Loss of suppliers. Suppliers may also be unwilling to provide a firm with inventory if they fear they will not be paid. 3. Loss of employees. Because firms in distress cannot offer job security with long-term employment contracts, they may have difficulty hiring new employees, and existing employees may quit or be hired away. 4. Loss of receivables. Knowing that the firm might go out of business or at least experience significant management turnover reduces the incentive of customers to maintain a reputation for timely payment. 5. Fire sales of assets. In an effort to avoid bankruptcy and its associated costs, companies in distress may attempt to sell assets quickly to raise cash. To do so, the firm may accept a lower price than would be optimal if it were financially healthy. 6. Inefficient liquidation. Bankruptcy protection can be used by management to delay the liquidation of a firm that should be shut down. On the other hand, companies in bankruptcy may be forced to liquidate assets that would be more valuable if held. Either way, this would lead to inefficient liquidation. The last one is costs to creditors. So aside from the direct legal costs that creditors may incur when a firm defaults, there may be other indirect costs to creditors. So who pay for these financial distress costs? The original shareholders of the firm. The reason being that debt holders are not foolish. They recognize that when the firm defaults, they will not be able to get the full value of the assets. As a result, they will pay less for the debt initially. Firms are aware of the costs of financial distress and bankruptcy that we just talked about. When choosing the capital structure, firms weigh the tax benefit of debt against the costs of financial distress and bankruptcy, and that is the so-called the trade-off theory. The presence of financial distress costs can explain why firms choose debt levels that are too low to fully exploit the interest tax shield. Differences in the magnitude of financial distress costs and the volatility of cash flows can explain the differences in the use of leverage across industries. Does leverage bring any other significant cost other than the financial distress costs? Yes, the agency cost. When a firm has leverage, a conflict of interest exists if investment decisions have different consequences for the value of equity and the value of debt. The agency costs of debt arise from conflicts of interest between stakeholders. It is most likely to occur when the risk of financial distress is high. And when a firm faces financial distress, shareholders can gain from decisions that increase the risk of the firm sufficiently. Asset substitution is to replace low-risk assets with riskier ones, or overinvestment, that is to undertake negative NPV but sufficiently risky projects. Shareholders may also choose not to finance new, positive NPV projects. Cashing out. Shareholders have an incentive to withdraw cash from the firm if possible when the firm faces financial distress. Debt overhang. Equity holders reject positive NPV projects which only benefit debt holders. Just like the indirect costs of financial distress, The agency cost of debt is paid by the shareholders and maybe also the existing debt holders. The Leverage Richard effect summarizes the observations of agency costs as below. Shareholders may have an incentive to increase leverage even if it decreases the value of the firm. Shareholders will not have an incentive to decrease leverage by buying back debts, even if it will increase the value of the firm. The agency costs of debt can be mitigated by managing the debt maturity. Agency costs are smallest for short-term debt, but on the other hand, short-term debt needs to be renewed frequently, so it may also increase the firm's risk of financial distress and its associated costs. Another thing can mitigate the agency costs of debt is the debt covenants. Just like a double-edged sword, leverage can provide incentives for managers to run the firm more efficiently and effectively, and this is known as the agency benefit of debt. Benefit number 1, concentration of ownership. In the first video of corporate finance, we mentioned that the main disadvantage of an IPO is the lack of ownership concentration. A disadvantage of equity financing is an advantage of debt financing. Leverage allows the original owners of the firm to maintain their equity stake. As major stakeholders, they will have a strong interest in doing what is best for the firm. Benefit number 2, reduce the degree of managerial entrenchment. What is management entrenchment? It is a byproduct of the separation of ownership and control. It describes a situation when facing little threat of being fired and replaced. Managers are free to run the firm in their own best interest. Practical examples of management entrenchment include overspending on personal perks. Managers may make large, unprofitable investments as empire building or just because they are overconfident. So how can leverage reduce the degree of managerial entrenchment? Leverage can lead to financial distress, and managers are more likely to be fired when the firm faces financial distress. To avoid getting into this situation, managers may be more concerned about their performance and less likely to engage in wasteful investment. In addition, creditors themselves would closely monitor the actions of managers. Together with the debt covenants, leverage can tie managers' hands and commit them to pursue strategies with greater vigor. This is the benefit number 3. Asymmetric information refers to, in practice, managers' information about the firm and its future cash flows is likely to be superior to that of outside investors. In this slide, we will talk about the implications of asymmetric information on capital structure. Signaling theory of debt. Firms use leverage as a way to signal good information to investors. Adverse selection and equity issuance. The stock price tends to rise prior to the announcement of an equity issue, and this is because managers have an incentive to delay the issue until any news that might positively affect the stock price become public. And the adverse selection leads to the Nanman principle. When a seller has private information about the value of a good, buyers will discount the price they are willing to pay due to adverse selection. And this is why the stock price tends to decline after the announcement of an equity issue. To avoid the negative impact of adverse selection, firms tend to issue equity when information asymmetries are minimized. The Perkin-Warder hypothesis states that managers will prefer to use retained earnings first and will issue new equity only as a last resort. This hypothesis is consistent with the aggregated data on corporate finance. In addition to all that has been discussed, the financing choice depends also on whether managers of the firm believe the firm is currently underpriced or overpriced by investors. Managers who perceive the firm's equity is underpriced will have a preference to fund investment using retained earnings or debt rather than equity. The converse to this statement is also true. This is known as marketing time view of capital structure. To summarize the topic of capital structure, of all the different possible imperfections that drive capital structure, the most clear-cut and possibly the most significant is tax. Agency costs and the benefits of leverage are also important determinants. The potential signaling and adverse selection consequences of financing choice must be considered. A firm's overall capital structure depends in part on the market conditions that existed when it sought funding in the past. Due to high transaction costs, it is likely that the firm would not change its capital structure unless it departs significantly from the optimal level. Thank you for watching. Have a nice weekend.